Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3, this is Section D, this is an application topic, calculate deferred tax assets or liabilities resulting from book to tax basis differences such as allowance for credit losses, inventory costing methods, and property, plant, and equipment. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. If you sign up for that, in that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time, literally just by watching 1 hour of a webinar. So make sure you go sign up for that. Again, it's free. And after you watch that, you're going to want to learn more. So make sure you also check out becoming a Superfast CPA Pro member, because Superfast CPA Pro members get access to a ton of great stuff. Mainly, they get access to the Superfast CPA Pro course, where we go super in depth on exactly what you're supposed to be doing every day for your study process. But also, they get access to the full 10-question versions of these 5-question YouTube videos. So if you like these 5-question YouTube videos that I post about all these different topics, if you become a Pro member, Pro members get access to the full 10-question versions in the Pro member forum. So make sure you check that out, because again, it's just another way to get a little bit more practice and a little bit more understanding. Now, with all that said, let's dive straight into the questions. All right, here we are at question 1. And just a reminder, the previous video was kind of a builder for this video, where we talked about calculating income tax expense, like for the current income tax expense. We weren't really talking about deferred taxes or anything like that. In this video, we are going to be talking about, of course, deferred tax liabilities and tax assets and things like that. So let's dive into question 1. The first thing that I always like to point out with every single video that I make is you want to read the last part of the question first. Reading this last portion of the question typically gives you context, typically tells you what you're supposed to be looking for in the question. So just by reading this last part of the question first, we know that we are dealing with a deferred income tax liability. Now, when you're doing videos like this, or when you're doing a lot of the same questions in your normal studying, this might feel like a strategy that's not really that useful. But remember, everything we do is trying to prepare you for test day. And this is a very good test day strategy, because on test day, you have no idea what you're going to be seeing. You're going to be seeing 50, 100 different topics, and reading the last part of the question first will quickly give you the idea for what you're dealing with in that specific question, because that question is probably going to be different than the previous question or the next question. So you want that quick context so you can quickly understand what you are dealing with, so you can answer the question as quick as possible. So again, what is the deferred income tax liability at year end? Let's go up to the top now, and we can kind of be thinking about this as we read through the rest of this. XYZ Corporation reported pre-tax income of $700,000 for the year. The following book tax differences were identified. The company recorded $25,000 as an expense for expected credit losses, which have not been recognized for tax purposes. Depreciation expense recorded for financial reporting was $60,000, while tax depreciation amounted to $100,000. The company donated $15,000 to a political campaign, and the enacted tax rate is 30%. So with all that information, again, what is the deferred income tax liability at year end? Now, if you've never really dealt with this before, that's okay. You might not really know how to do this. But if you've seen this before, or if you have an idea, great, pause the video and try to do it on your own. The main idea behind these questions, again, is to use them to learn what we're supposed to be doing. So if you don't know how to do it, that's okay. We're going to click on the answer. If you have an idea, try it a little bit yourself and then come back and we will look at the answer together, and we'll start building our understanding just by looking at the explanation and learning from what the question teaches us. So again, if you want, pause the video, and if not, let's go ahead and look at the answer together. All right, here we are. The answer is B. $4,500 is the deferred tax liability. Now that's the answer, but we have a pretty big explanation here. This explanation is going to give us a lot of context for the rest of the video. So let's read through all of it, and I'm just going to scroll down a little bit more so we can see everything. Okay, now we can see the full explanation. A deferred tax liability arises when a company reduces its taxable income now, but will owe more taxes in the future as timing differences reverse. This often occurs when tax rules allow expenses like depreciation to be recognized earlier than for financial reporting. So this is something that might confuse you at first, deferred tax liability, deferred tax asset. But as we walk through this, I hope that you start understanding why it's considered a deferred liability or a deferred asset. Let's walk through this. For financial reporting, the company recognized $25,000 in expected credit losses, but this amount is not yet recognized for tax purposes, because under tax, an actual bad debt expense must be recognized, not just an accrual. This creates a deferred tax asset because the company is paying more taxes now and will pay less in the future when the expense is recognized for tax purposes. So I'm just going to reiterate that one more time. This creates a deferred tax asset, and we're going to talk about the calculation in just a second, but this creates a deferred tax asset because they're paying more taxes now so that in the future they are going to pay less taxes. That's why it's a deferred tax asset. And you might be thinking, well, they're paying more taxes now. That's not an asset. That's not a good thing. But remember, they're paying more taxes now so that they pay less taxes later. And, typically the way taxes work is taxes increase. So it's often better to pay more taxes now if you can manage it than to pay them later because they will probably be higher later. Again, that's why it's a deferred tax asset. They're paying more taxes now so that they pay less taxes later. And the way we calculate the deferred tax asset is we take this difference, the $25,000 difference, multiply it by the 30% tax rate that we were given, and that gives us a $7,500 deferred tax asset. Now let's go to the next thing. The company recorded $60,000 of depreciation for book purposes, but it claimed $100,000 for tax purposes. The higher tax depreciation lowers taxable income now, but will lead to higher taxable income in future periods. This creates a deferred tax liability. So this is the opposite of what we were just talking about. If you pay more taxes now and less later, that's a deferred tax asset. But if you pay less taxes now and more taxes later, that's a deferred tax liability because you're going to owe more taxes later. You're deferring those taxes for later. So that's why this is a deferred tax liability, because right now the tax depreciation is $40,000 higher than the book depreciation. So that's $40,000 of extra depreciation expense that will lower their taxable income this year, like right now. So that is helping them currently, but in the future, as these temporary differences reverse, that will be a deferred tax liability because they're going to have to pay those taxes later. So we take the $40,000 difference, multiply it by, again, the 30% tax rate, and that gives us a $12,000 deferred tax liability. So we have a deferred tax asset and a deferred tax liability. And then one last thing that we want to talk about before we calculate the net tax liability, we talk about there are also permanent differences when it comes to book and tax. There's temporary differences, and these are the things that cause deferred tax liabilities and assets, but there are also permanent differences. This arises from non-taxable or non-deductible items. The $15,000 donation to a political campaign is a permanent difference because such contributions are not deductible for tax purposes, period. You cannot deduct political contributions as an expense when it comes to taxes. That's a permanent difference. They do not create deferred tax assets or liabilities because they do not reverse in future periods. So if there's ever a difference that you're looking at and it says it's non-taxable or it's non-deductible and it will never be reversed or whatever, or if you just kind of have an idea of what is non-taxable and non-deductible, then you know that's a permanent difference and that's not going to create a deferred tax asset or liability. So that's one thing there. Don't get confused by this. There's a deferred tax liability and there's a deferred tax asset. You seem to typically kind of net them. So you net the deferred liability and the deferred asset, and that gives you a net deferred tax liability of $4,500. So that's how we got to that answer. So we learned a lot in just this first question. This was kind of a big question. This will give us a big understanding and a good base for the rest of the video. So let's go ahead and go to question 2. All right, here we are at question 2. What is the total deferred tax asset at year end? Now, we learned a lot about deferred liabilities and tax assets in just the first question. So I bet you could figure some of this one out. Let's read through all of it. Cedar Valley Construction reported pre-tax income of $950,000 for the year. The following book tax differences were identified. The company accrued $40,000 in vacation pay for employees, but has not paid any vacation time out yet. The company received $25,000 in advance for services that have not yet been performed. The company incurred $15,000 in penalties for regulatory violations, and the enacted tax rate is 20% for all of this. So what is the total deferred tax asset at year end? Now again, based on what we learned in the previous question, I bet you could kind of think through this and maybe figure it out on your own. If you still don't really know how to do it, that's okay. We're going to look at the answer and figure it out together if you haven't already paused the video. All right, here we are. The answer is C. $13,000 is the deferred tax asset. So let's walk through this. Accrued vacation pay. This is a temporary difference. The accrued vacation pay which was $40,000 creates a deferred tax asset because the expense is recognized for financial reporting now, but will not be deductible until it is paid in the future. And don't let that confuse you. It's saying that for financial reporting, it's deducted, but for tax reporting, it's not. So our taxable income is higher as a result of this, but will be lower in the future as we're able to start deducting it in the future. So that's why it creates a deferred tax asset, because in the future, we will have lower taxes than now. So $40,000 multiplied by 20%, that gives us an $8,000 deferred tax asset. Then there's the revenue received in advance. And this is something that you need to know when it comes to taxes. The $25,000 advance payment creates a deferred tax asset because the revenue is recognized for tax purposes now, but deferred for financial reporting. So because we are recognizing $25,000 for taxes now, compared to for financial reporting, it will be recognized later, that is going to create a deferred tax asset because, again, our taxable income is higher by $25,000 now, and in the future, as that reverses, because this is a temporary difference, that is going to create a deferred tax asset. So deferred tax asset, $25,000 multiplied by 20%, $5,000. So we have 2 deferred tax assets so far. Now the penalties, this is another permanent difference. This is something that can never be deductible for tax purposes. If you have a fine or a penalty or something like that from the government, you can't deduct those for tax purposes. So that's another permanent difference. So that's not going to create a deferred tax asset or liability. So we add these 2 deferred tax assets together, $8,000 plus $5,000, that gives us $13,000 of deferred tax asset. I hope that this is kind of starting to sink in. Now let's go to the next question. All right, here we are at question 3. What is the deferred tax expense for the year? So this is a little bit different. This is another way that they can ask a question about deferred taxes. So let's go up to the top. Maple Valley Solutions reported the following for the current year, its first year of operation. Pre-tax income, this was the book basis, $900,000. Taxable income, $950,000. Enacted tax rate for the year, 30%. Tax rate for future years is 25%. The tax depreciation exceeded book depreciation by $50,000. And the company accrued $20,000 in warranty expenses for financial reporting purposes, but these expenses will not be deductible until next year. So with all that, again, what is the deferred tax expense for the year? Now, this is something we haven't talked about explicitly yet. We've talked about deferred tax liability, deferred tax asset. What is the difference? What's the deferred tax expense? If you don't know, that's okay. We're going to use the answer to figure it out. If you have seen this before though, pause the video, try it on your own, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is C, $7,500. That is the deferred tax expense. So let's walk through this. A deferred tax expense occurs when the increase in deferred tax liabilities exceeds the increase in deferred tax assets. Now, just letting you know, this is kind of the other side of the journal entry when it comes to deferred tax liabilities. The opposite side of a deferred tax liability is a deferred tax expense, and the opposite side of a deferred tax asset is a deferred tax benefit. So this is kind of like the opposite side of the journal entry, so that's why it's called a deferred tax expense. Let's walk through this. Tax depreciation, again, this is a temporary difference. The tax depreciation exceeded book depreciation by $50,000, which creates a deferred tax liability because they are reducing their taxable income this year, but it's going to be reversed and they're going to have to pay more taxes in future years, so that's why it's a liability. So $50,000 multiplied by the 25% in future years, because remember, deferred tax liabilities and assets are in future years. And so even though the 30% tax rate is for the current year, in future years, when these deferred tax liabilities and assets actually take effect, the tax rate is going to have changed to 25%. So that's why we use 25% here. And then the warranty expenses, the company accrued $20,000 in expenses that will not be deductible until next year. Because again, under taxes, you can't accrue bad debt or warranty expenses. You can only record them when they actually occur. So that's why they're not deductible this year, because they haven't actually happened. Now on the financials, they're accrued, so they're there, but for tax purposes, you can't deduct them as an expense until they actually occur. So this creates a deferred tax asset because taxable income is higher now because you can't use those expenses yet, but it will decrease when the expense becomes deductible in the future. So $20,000 multiplied by 25% gives you $5,000. So there's a deferred tax liability of $12,500 and a deferred tax asset of $5,000. So to calculate the deferred tax expense, $12,500 of the liability less the $5,000 of an asset, that gives you $7,500. And again, remember, this is kind of what we did in the first question where we netted the liability and the asset, but the deferred tax expense is the other side of the deferred tax liability. So when you see deferred tax expense, a lot of times it is kind of talking about the other side of a deferred tax liability. The deferred tax expense reflects the net increase in future taxes owed. Again, remember the deferred tax liability that so that's what you're going to owe in the future, primarily driven by the temporary difference from accelerated tax depreciation. So this was the main cause of the deferred tax expense, but we netted it against the warranty expense difference as well. All right, we learned a little bit more there. Let's go to the next question. All right, here we are at question 4. What is the total income tax expense for the year? Let's go up to the top. Silver Horizon Industries reported the following for the current year. Pre-tax income, $1 million. Taxable income, $950,000. The enacted tax rate is 25%. During the year, the company had the following changes in deferred taxes: an increase in deferred tax assets of $12,500 due to accrued expenses not yet deductible for tax purposes, an increase in deferred tax liabilities of $7,500 due to differences in depreciation methods. So again, with all that information, what is the total income tax expense? So we're given a lot of information here. What are we going to have to calculate to figure out the total income tax expense? If you have no idea, again, that is okay. We're using these questions to learn. So pause the video if you want to give it a try. If not, let's go ahead and look at the answer together to see what the total income tax expense is, compared to deferred tax liabilities and things like that. All right, here we are. The answer is C, $232,500. That is the total income tax expense. So this is a little bit different than just a deferred tax asset or liability. This is taking into account the current income tax expense, and this is something that we covered in the previous video. So this question's kind of building on the previous video. Let's walk through this. Total income tax expense is calculated as the sum of current tax expense and deferred tax expense. So we've been learning about deferred tax expense, and in the previous video, we learned about current tax expense, so we're putting it together here. Now, as a reminder, the current tax expense is the taxable income, not pre-tax income, it's the taxable income, multiplied by the tax rate. So $950,000 multiplied by 25% gives you $237,500. The increase in deferred tax assets reduces deferred tax expense because it represents future tax savings. So you're going to be paying less taxes in the future because of this deferred tax asset. So it reduces the total tax expense. So we reduce it by $12,500. The increase in deferred tax liabilities increases deferred tax expense because it represents future tax obligations. So they're going to have to pay more in the future because of this. So what do? The net deferred tax benefit is the $7,500 liability increase less the $12,500 asset increase. And again, this creates a net deferred tax benefit, not a tax expense. And that's because, again, the asset increase was greater than the liability increase. So it's actually a negative $5,000, which is actually a good thing in this case because it's going to reduce the total income tax expense. You take the current tax expense plus the deferred tax expense, which technically is a deferred tax benefit. So $237,500 less $5,000 gives you $232,500 of total income tax expense. So total income tax expense is where you just take everything into account altogether, the current and the deferred taxes, and you have to figure out what the increase and decrease is for the liability and the asset. Now let's go ahead and go to the next question. All right, here we are at question 5. What is the deferred tax liability at year end? Let's go up to the top. Willow Manufacturing reported the following for the current year. Pre-tax income, $750,000. Taxable income, $720,000. The enacted tax rate is 30%. Depreciation expense for financial reporting was $40,000, while tax depreciation was $70,000. So this is a pretty simple question, especially because of what we've learned throughout this whole video. So I expect you to be able to do this one on your own. Pause the video, do the calculation, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is B. $9,000 is the deferred tax liability. This is a simpler question because, again, we've learned how to do this up to this point. So at the beginning of this video, you might have had zero idea how to calculate this, or you might not have really known what to do. But now this is a pretty easy question. A deferred tax liability arises when taxable income is lower than book income due to timing differences that will reverse in future periods. This represents taxes that the company will owe later. And the only thing that was mentioned here was the depreciation. Tax depreciation exceeded book depreciation by $30,000, and that was the $70,000 less the $40,000, reducing taxable income now. This also creates a temporary difference, but increases the deferred tax liability. So deferred tax liability, $30,000 multiplied by the 30% tax rate, that's $9,000. So deferred tax liability, not too difficult to calculate. In fact, all of the stuff in this video isn't too difficult to calculate as long as you understand how it works. Now, we learned a lot in just 5 questions, and to make sure that this all hits home a little bit more, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 questions trying to teach you how to calculate a deferred tax liability, or you've seen 3 or 4 questions trying to teach you how to calculate a deferred tax expense or deferred tax asset, or whatever the case may be. These are the things that you see continually throughout the questions that you're studying that day. So you take a moment and you write down your pillar topics in your own words. These are, again, the most important things that you learned from the questions that day. And as you're doing this each day, you will be creating a personal repository, again, in your own words, of the most important things that you need to know for the exam, so that by the time you get to exam day, you know what you're supposed to know for the exam. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's go ahead and just read through it. Deferred tax liabilities. That's the first thing we're going to talk about. Deferred tax liabilities arise when taxable income is lower than book income due to temporary differences, such as accelerated tax depreciation. That's like the most common one that I see. These liabilities represent future tax payments as the differences reverse. Again, deferred tax liability, you have less taxes now, but you're going to have to pay those taxes later. So that's a liability that you have to pay in the future. So it's a deferred tax liability. Deferred tax assets arise when taxable income is higher than book income due to temporary differences, such as accrued expenses not yet deductible for tax purposes. That could be like warranty expenses or even like an accrual or something like that. These assets represent future tax savings as the differences reverse. So you're paying more taxes now, but you're going to be paying less taxes later as these differences reverse. So in the future, you're going to have this tax asset that's going to help you out. Now, we've talked about this throughout the whole video, but I just want to make sure it's clear one more time. There's a difference between temporary and permanent differences. temporary differences create deferred tax assets or liabilities because they reverse over time. They're just a temporary difference between book and tax, but over time, book and tax will eventually have done the same thing. But the reason that it matters is because taxes are different in different years, while permanent differences, such as tax-exempt income or non-deductible items, never reverse and do not impact deferred taxes. So this would be things like non-taxable income like municipal bonds or non-deductible expenses like fines. Now let's talk about the total income tax expense. Total income tax expense under GAAP includes both current tax expense based on taxable income and deferred tax expense reflecting changes in deferred tax assets and liabilities during the year. And finally, let's talk about deferred tax rates and timing. When calculating deferred tax assets and liabilities, use the enacted tax rate applicable to the period when the temporary differences will reverse, reflecting future tax obligations or benefits. So if there is a current tax rate, but in the future there's going to be a different tax rate, you use the different tax rate that there's going to be in the future because the deferred tax assets and liabilities are going to occur and reverse in those future periods. Now again, we talked about a lot in just 5 questions and we've gone over the pillar topics. And with that, that is the end of the YouTube version of this video. I hope this was helpful. Remember, if you become a Superfast CPA Pro member, you will get access to the 10 question video that I'm about to make after this, where Pro members get access to another 5 questions to help them understand and learn this a little bit more and a little bit better. So make sure you check out becoming a Pro member. Also, make sure you check out the Superfast CPA training webinar, where we go over the key ingredients to passing the CPA exam. Again, it's only 1 hour, it is free, and we will save you months and months of time by teaching you how to study more efficiently and better in just 1 hour. Now with all that, again, I hope this was helpful. I hope you liked the video. If you liked it, make sure to like it and leave a comment, and I will see you in the next video.